Well, welcome back, Eddie. Great to have you on here for our third quarter investment review and outlook.
Yeah, I've been on hiatus for a little bit. I know we had Joe Cortese here and Gary for our last one. So those they're great guys, and Joe's a great partner, and obviously Gary's history with us and with you specifically have been great to have them on. But yeah, I miss doing these. These are a lot of fun, and it's good to kind of just talk through some things and give some folks some information. And more importantly, we're just trying to give people perspective. Not only, just a kind of a balanced perspective is what we try to do. So it's good to be back.
Absolutely. Well, that's a great way to kind of just lead right into what we're going to talk about. So there's a lot of data. We definitely, use data. We're not just flying by the seat of our pants and do whatever we feel like when it comes to investing. At the same time, we don't want to focus on just the short term
Yeah.
and just what the data says today, but also have a balanced view, as you said, kind of for the long run. So we're going to actually jump right in to looking at the year all the way through
Great.
September 30th. And
Yeah.
then where do we go from here? So let
Let's do it.
me
Yeah. That sounds great.
share my screen. I think you can see this now.
Yep.
Okay, so we've got our quarterly considerations, and we can send this out to anybody who's interested. Basically, as we look, there's kind of three main points, market themes, as we think about the third quarter. So the first one, number one, is just that the Fed is likely done raising rates, or at least a substantial amount, and you can kind of see that in the chart over here on the top right. That this is just what happens after you're done raising rates. Looking historically, that's actually really positive, and it's really positive for all financial markets. And this is just the forward-looking return for bond stocks and the SP 500, as you would see there. So just starting there, if the Fed is pausing or done, that should look really good if we look out the next couple years going from there. Any thoughts you want to add to that piece?
Yeah, I try to think kind of in like sections and not just specifically. But I remember last year we were just fielding some calls, and really the Fed started raising rates significantly, and it had a lot of effects obviously on the markets. Incidentally, you can actually track some of those times where the largest drops last year were when the Fed announced, 0.5% or some of these larger percentage interest rates. So it was just a lot of rightful analysis and concern of what that was going to do. But these are market cycles, and I think that's the point is that these things happen. We were just happened to be in a relatively very easy kind of policy setting, and things were just really on autopilot. And it was a unique time to kind of see this happen. And things have moderated, and for a lot of respects, we believe that we're not going to see a whole lot more. There's a lot of factors you can get into that as well, but I just think it, we may be on a somewhat of a easy pass from an interest rate policy, but we don't know. Something could happen, and there could be an adjustment. And because some folks talk about possibility of some rate cuts
Mhm.
in 2024, and that's a possibility for sure. We just kind of looking at it, and ultimately how does that affect the portfolios and other opportunities, whether that's purchasing bonds at a higher yield and
Mhm.
whatnot.
Absolutely, and that leads to the next thing. Before I jump there, I just want to add, I don't have this chart prepared, so just bear with me. But if you think about interest rates and where they've been over time since the great financial crisis 2008, we've been on this very um, accommodative Fed policy. Interest rates have been very low, and that led to the bull market in stocks that we had. And as interest rates fall, that's good for bonds. We are now in a time period that's different than the last 15 years, but it is more normal if you look at a longer
Yeah.
view, a 100-year, 150-year view. Because the Fed policies have been around for 100 years. And so
Hmm.
you can see different markets other than just the last 15 years. And rates are not that high
Hmm.
historically. They're just really high for the last 15 years. And there are some things that maybe people have gotten used to the last 15 years from investing that they need to change now. And part of that is some changes we made to portfolios earlier in the year, some things with the international funds, stuff like that. And we're going to talk about some other changes that we've made in a little bit. But as we look ahead, if you are a long-term investor, higher rates are good because higher
Hmm.
rates allow you to have a nice floor on what you can earn for your safe money.
Hmm.
And if interest rates are no longer rising, you're not worried about bonds losing money, and stocks don't like uncertainty. So as long as we're pausing and the Fed is announcing here's where we're going to go, that should be a positive thing for stocks, whether it's at this level or a higher level or even a little bit lower level. All of that is good so that people can in management can make decisions based upon the interest rate environment that we're in. So just because rates are higher than you've been used to the last 10 or 15 years does not
Hmm.
mean that we should run away from stocks or anything like that.
Yeah, yeah.
Um,
No, and there's other things that again we can make some rational assumptions and some probability, but interest rate environment is higher, so there's a difference of for companies that are looking to finance certain expansion or whatnot, and those are real costs that affects bottom line. So it's a possibility that some of those things could trickle down in a couple quarters down the line, but if you look at some earnings for a lot of companies, a lot of these major companies, they for this year they've been I think surprising in a lot of ways, and it just shows you that the data can be really kind of in flux, and you can make some assumptions. So
Well, and I'll jump. You mentioned, earnings and things, and I just want to point to this top left that we have up here. This is a new chart, but U.S. real GDP growth. So just in layman's terms, that is for the United States, what is the inflation adjusted growth of the economy? And
Mhm.
you can see that quarter over quarter, um, we have some different, time periods. You had some negative returns or negative. GDP growth,
GDP,
or
yeah.
also called a recession, in 2022. But if we look so far the last 4 quarters, that's very positive. And if we just chug along 2, 3, 4%, that's going to be positive overall. And that's during a high inflationary environment. So nominal growth, which is before you discount inflation, actually is much higher than these numbers that you see here. And so all that's to say is the data, although there is some negative things out there, the data is actually pretty positive. Now, you mentioned this a few minutes ago. The Fed may lower rates, but I don't know that any of us should be cheering for that, because the
Hmm.
only way the Fed's going to lower rates
Yep.
is if these numbers start to go the wrong direction.
Yep.
And if people are losing jobs, don't have enough money, taking out a lot of extra debt, which you've seen some rising debt here in the top right corner that we have
Hmm.
there. There is, debt levels are rising, things like that. But so far, it's not something that's flown through and stopped spending. But if spending were to stop and these numbers come down, then the Fed is going to have to lower rates. But I think we'd much all prefer to have a stronger economy with rates where they are than
Yeah.
have the Fed have to lower rates just to be more accommodative.
Yeah, yeah, no, for sure. And it's I mean, these are some of the kind of themes or narratives in the market or in news, if you will, that the Fed is trying to orchestrate a recession to bring down their the inflation rate to their preferred 2% level. And whether that's true or not, I think most people would rather have a job and have income coming in and be able to have some meaningful resources to figure out how they can, survive and pay their bills, as opposed to not having a job and then, having these outcomes. So sometimes we talk about these things or hear these things talked about in kind of these large market cap ways, but there's, as you mentioned, there's some real personal meaning for it. And fortunately for most of us here, we all have jobs, but your point, there's a lot of data. Hey, credit rates are going up in terms of limits and all that stuff. I mean, just today, consumer spending's up relative to what they was expected. So I think a lot of those GDPs are really a testament of the strength of the consumer. Even though savings rates have gone down, there's a lot of things that are trickling there, and it's been surprising. I mean, again,
Americans are really good at spending money.
they are. Yeah, and especially if you have kids, it's even more. You got all
That's
these
right.
kids and all that stuff. So, but yeah, so there's a lot there for sure.
Absolutely. So let's jump back in kind of to our next theme, which we kind of touched on already, but just to make sure we close the loop on all that. So rising kind of point number two on this theme is rising interest rates have increased how bonds are how attractive bonds look compared to stocks. So if we go to the bottom left corner that we have here, the solid blue line is your S&P 500. That's stocks, U.S. stock earnings yield. That's kind of what you earn on the earnings, kind of the opposite of a price earnings ratio. And then the Bloomberg Ag Index, which is just what are all the bonds out there paying. And you can see how those numbers have come close together. And basically, since the tech bubble burst, they haven't been this close before. And there are really positive things you can say about this, and there are some things that could be scary if you look at it. And I'll kind of start with the latter. A lot of people will point to this, the fact that the yield curve is inverted, price earnings ratios, which again is the opposite of the earnings yield, and say stocks are overvalued and we need to run away from stocks. And there's some compelling arguments about that. At the same time, I view this as a long-term investor who says stocks over the long run do better than bonds
Hmm.
in any market.
Yeah.
As long as you stay invested, you expect, and it has played out, if you stay invested long enough, stocks will do better than bonds. The timing matters. I'd much rather buy when it's really cheap than when it's not. But if you want to earn long-term returns, you need to have some stocks.
Yeah.
So we're going to keep buying stocks. All this does is has a nice higher floor that we can earn for your portfolio. So
Hmm.
from today going forward, I am much more optimistic that we can hit the target returns we need for all of our clients than a year ago.
Yeah. 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 And I also think a part of that is, um, risk tolerance, where you are in the cycle. Some folks that are in the wealth accumulation cycle, so you want to be buying through down periods, because that gives you, the greater. You buy more shares at a lower price, but you have some other folks that are in retirement. They've already accumulated wealth, so the calculus is a little bit different. It's more wealth preservation, also, keeping up with inflation and even having a positive return. But the expected return may not be as high relative to their overall financial plan. So, the portfolio is really, really important. I always say it's the jet fuel that actually gets that beautiful jet up in the air. But there's a lot of other components of this when it comes to financial planning, and what are the goals of an individual's household. Could be estate planning, could be gifting. There's just a lot of other things there. So those are all kind of things that I think a lot of times we talk about what's the return, what's best, and those things are really, really important. However, there's other components that we have to take into effect as we're walking and thinking through those things for individual homes, and assessing risk. And hey, the the market is risky. There's
Mhm.
nothing guaranteed about it. It's why regulators are very specific about making sure firms like us and individuals are not guaranteeing folks they're going to get
Mhm.
something, because frankly, we can't guarantee anything.
Right. Yeah, and with interest rates where they are, when I look at charts like that and in fitting it into the overall financial plan. That's why we're talking to clients about, does it make sense maybe to buy an annuity now because rates are a lot better. We can lock
Mm.
in a better rate for an immediate annuity, pay you some income. Those are contracts that, as long as the company's around, it's going to pay you. It is a
Hmm.
guaranteed. It's not a return. It's a guaranteed kind of payment that the insurance company's guaranteeing. Those are the sort of things that higher higher interest rates
Yeah.
allow us to look at that 5 years ago weren't even on the radar as an option
Yeah.
because rates were just so low. And so, again, while there are reasons in the short term maybe to be concerned, and we haven't even touched on geopolitical things and what's
Hmm.
going on in
Yeah.
Israel, and,
Yeah.
and you still have the war in Ukraine and everything, um, there are always reasons to be concerned in the short term.
Yeah.
But as
Yeah.
long as capitalism is here and um, companies are trying to do better and make more money, and GDP growth is positive, there is opportunity in both bonds and stocks from
Yeah.
where we are. So
Yep.
with that, I'll
For
kind of
sure.
go to the last kind of key theme, and then we'll touch on a few other things. Inflation, and here I'll reshare my screen here. Inflation has improved a lot better, meaning it's come down since it peaked at 9%.
Hmm.
The Fed has always said 2% is their target. I remember, again, just going back, 4, 5, 6 years ago, the Fed was trying to get to 2% inflation, could never get there. And now,
Hmm. Yeah.
now we're kind of backfilling that, and it'll probably average 2% over the long run, with some years where it's less and some years when it's more. The last couple steps here probably are going to be very difficult to do, as again, conflicts in the Middle East are going to impact oil prices. That this number's even produced before that happened, but there are a lot of things that are out there that make inflation hard to get a hold of. Now, let me give you
Hmm.
the positive on that, though. While prices for all of us are going up, I hear all the time concerns about the debt levels that the United States has. And, you and I have talked, Eddie, about refinancing of debt, of how much of the next 2 years of U.S. debt is going to have to be refinanced at higher rates. Well, here's the
Hmm.
thing: the best way for a debtor to get out of debt is to have high inflation. Inflation's
Yeah.
great if you're borrowing money, because
Yeah.
the money you're repaying it back is not worth as much.
Hmm.
And so if you're someone who's worried about the deficit and worried about US debt levels, high inflation is actually positive if that's
Yeah.
something that's concerning to you. If you're not worried about that, then and you're spending money and you say, I really hate paying more at the grocery store or whatever
Yeah.
else. I agree with that. I hate seeing that. I just had to fill up my gas today, and you never want to do that, although it's better than
Yeah.
it's been.
Yep.
That said, there's positive and negatives to everything here.
Yeah. Yeah. I just think ultimately is we're living in a world that's a little bit more complex, and COVID, just it seems so far, but it's still such short time away happened. It changed kind of a lot of the dynamics structurally, society, politically, and you've got, as you mentioned, some of these other geopolitical things, and there's possibly other things that are going to happen as well. But again, there's a sense of optimism. I actually think someone was it was one of the earnings calls I was listening to, is one of the, I think it was a bank CEO. He was saying, and never in my entire career have I seen such a deficit of hope in this
Mm,
world. And he kind of went on to say there's a lot of reason to be hopeful and optimistic. And he was very balanced. He kind of saying, hey, there's things that we should be very concerned about, and all those things are true. But I think it's, again, what we're trying to achieve here is to tell you, hey, yes, there are some things that are concerning, but there are some very promising things as well. And you could almost go back in time and take specific times or predictions of things that happened, and there were some doomsdayer stuff, and we've made it through. And I think part of the American life is that we find a way to do things, and we find a way to innovate and to improve, and all those things are going to continue to be true. And there's going to be some challenges on the way. We can't see them all, but we should be as prepared as we can, and also kind of striving for an optimistic, better future. Because what's the purpose of living if we don't have a hope for a better future that's ahead of us?
mhm.
And if we're just constantly thinking of just the storm and the storm, and it's like here in Florida we have hurricanes, and a lot of times we get a bigger one, which we had 2 years ago. And I remember it was just, the peak of the storm was about a cat 1 in our home, and you could just hear the roof and everything. And my kids are sleeping. And it was like I was just very alert and aware, and it was concerning some ways. But I knew that in the morning this was going to pass through and it was going to be better. And I think that's a good way to try to aspire to work through some of these challenging times that we're living in.
I have to laugh. I agree with everything. If anybody who's listening to this wants to see a video of Eddie in his attic that day,
Oh my
he did
gosh.
send me a video during the hurricane. But no, but
Yes, what I left.
you're still
Go ahead. Go ahead.
hopeful.
That's a
You're
story for
still
a different
hopeful.
day. Yes. Yes. Yeah.
No, but I think that's great, and I almost wish you would have said that to the end because that's a great way to wrap up. But and we'll touch on that again
Yeah.
in a few minutes. But um, there's always a reason to be worried,
Yeah.
and there's a lot of studies that say that that humans are naturally primed to focus on the negative,
Hmm.
naturally primed to worry about what could go wrong.
Yeah.
And a lot of that is loss aversion, and there's a lot of psychological things that are there and biological
Hmm.
things. And overall, that works out really well. Where that doesn't work out well for us is if you're an investor and are going to react to it. And so it's fine to feel the negativity, and it's fine to feel that. It's fine if you feel that way, but part of our job is to make sure that we're focused on the long term and not just the short term,
Yeah.
on everything that happens. And so if those really negative predictions happen in the next 3 months or 6 months or 2 years, whatever that is, if we go to a recession, the Fed starts lowering rates a lot. If geopolitical conflicts get bigger or worse, or China invades Taiwan, whatever that looks like,
Yeah.
there will be opportunities for long-term disciplined investors to invest. And we hope none of those things happen, because I'd much rather have a slow and steady, just nice little GDP growth and everyone's happy.
Hmm.
Um, it probably won't. History
Yeah.
tells us there's always going to be some big events. At the same time, even through all those events, you still have positive returns,
Yeah.
stocks, bonds, everything else. And so we're going to take advantage of those opportunities on your behalf for reinvesting and everything else. So let me jump in last couple of charts that we have here, and we'll talk about a few other just things that I think are important for people
Yeah.
to keep in
Cool.
mind.
Great.
So want to focus here on the bottom right, just because that's something that people have talked about a lot. We have real estate investments in our portfolio for our clients, and a lot of people say, well, I really, really don't want to own commercial real estate. Like, why do I have real estate at all? Office buildings. Have you been downtown Chicago? Have you been to any city? Have you seen? I mean, most of us are working in a way that is very different than it was a couple years ago. And so all that is true. But it's important to point out in this bottom right, only 5% of the public real estate market is exposed to office REITs,
Mm.
office real estate. That means that 95% of your real estate investments that we would have don't have that same problem that you're reading about in the Wall Street Journal or is on the news or whatever else. That doesn't mean that every area of real estate is positive outside of that, but it's important to keep perspective on what we're actually talking about when you read those. How does that fit your portfolio? Now, with all that said, we have started to make some changes, and so you might get some trade confirmations on this. There are a few real estate funds that we've used in the past that are basically, in short, took on so much money that they had to expand their pool of available options to own things we didn't want to own anymore. It wasn't why you owned those funds to begin with. And so we made some changes to the real estate area of the portfolio just to make sure that we have what we actually want to own when it comes to real estate, give you the exposure to real estate. So there are some changes. Happy to walk through that with anybody. Just reach out if you have any thoughts or questions. But I do think just understanding that only 5% office real estate in the REITs is an important perspective.
Hmm. Yeah. Yeah, no, it's part of the ongoing management of the portfolios, and you overseeing these on a regular basis, working with some of the partners that we have, and Joe, as we had him on last video. So those are the things that we're always looking at, and you're
Mhm.
obviously making those final determinations. So
Sure.
it's a good example of that.
So let's jump into just kind of returns here, and this is just overall for asset class returns. If we look here in this dark blue, this is fixed income bonds. The solid bars are going to be year to date return, and then the circles are the third quarter that just ended September 30th. So you can see that, overall bonds have not done very well this year. That makes sense. When interest rates go up, the price of bonds drops. That's negative for in the short term for bond returns. It's very positive for returns in the future. If we buy a new bond today at a much higher interest rate, we're locking that in. As long as it doesn't default, we know you're going to get your interest and the principal back. When we look then in stocks, this is in the gray here. Stocks have been very positive. Best place to be invested, again, is U.S. large cap. That has been the story basically since the great financial crisis. And that's up 13% for the year, down 3% in the quarter. Stocks were down, as you can see, across the board in the third quarter. And then just kind of real assets. So that's real estate, real assets, commodities, all are flat to negative for the year. And, pretty much if you look, most of these circles are on the negative side. So the third quarter overall was not very positive for a diversified portfolio. There are, again, always pockets that do well, but over the long run, we're still much better off this year than we were at the beginning of the year and last year. As a reminder, I mean, stocks were down. I think they finished the year down, I want to say like 15%. Bonds were down 11 or 12%. I mean, it was pretty negative. Again, worst year in the last 200 years for a stock bond portfolio was last year. This is a much better year to be in, and hopefully people are seeing that and happy about that.
Yeah. No, and I think kind of summing this up, started with interest rates and kind of the effect on certain asset classes, and 2022, maybe even 2021, a lot of it was, hey, there's no alternative to stocks, and bonds were just garbage, and like, I mean, there's a lot of attractiveness to some of that stuff now. So relative to someone's, kind of risk tolerance, what their goals are, as you mentioned, it makes sense a lot of times to kind of reallocate to some of that, and within the overall construction of a portfolio. So there's opportunity out there, I think, is what what we're trying to communicate. And there's not a one size fits all, and there's kind of a meticulous approach to some of this stuff. And it's an individual kind of discussion, and we understand that certain things cause fear and concern. And last year we were hearing from clients a lot more regularly, and we were always proactive in reaching out, but things were being said and heard and felt because some of these things were happening. And we totally understand it. It's it's hard-earned money, and there's estate planning that goes into that. They want to be gifting, and even surviving, make sure you don't outlive your money. And those are, again, the planning things that a lot of times are not really taken into effect. The returns are important because of these other things. And we're working through all those things for folks individually. And, it's definitely unique and a challenging time in a lot of ways, but, we're working through all those things and thinking probabilities and possibilities, and what's more realistic and isn't for overall.
For sure. I want to close with kind of one quick thing. We've gotten a few questions from clients as they've seen what we've done over the years, and it's kind of a two-part thing. So one, right now you're talking about planning. Part of the planning is tax planning, and part of the tax planning for the portfolio is kind of two big things that we're doing on an ongoing basis. One is making sure you have the right types of investments in the right types of accounts. So we talked about real estate. If you came in and you had cash and you had IRA and you had a brokerage account or a trust account, and I could allocate the money, I would not put any of the real estate in a brokerage account. I put it all in an IRA for tax reasons. It's called asset location. And we actually, for every single investment that we have an order of how tax sensitive do we need to be and where do we want to put it. Now, over time, portfolio changes where there's cash available. It won't be exactly perfect, but that's part of what we're doing on an ongoing basis. The other piece that we're doing is called tax loss harvesting. And so tax loss harvesting is when you have an asset that is down, it's lost money, we can actually sell it, reduce your tax bill for the current year, and then rebuy something. We can't buy the exact same thing in the same 30 days, but we can buy something similar. And so that's what we're doing. And so part of why we're doing the real estate changes now is if somebody owns a real estate fund in a taxable account, it's been down the last couple of years. We're going to sell that intentionally because it's down,
Mm-hmm.
reduce your taxes, and move to a new fund. Excuse me. So that is an important piece. Now, if you log into your Charles Schwab account and you see your cost basis, you see maybe the gain and loss that's there, or you see the realized gains or losses, that is not always going to reflect accurately what you've actually returned, because we make changes over time. Dividends, interest, bond maturities, they get paid out, they go to cash, they don't show up on the gain and loss. And so for a lot of funds, especially those that pay a lot of dividends, it's going to look like you have losses that you don't actually have, that you have gotten income out of, and it's actually been a positive investment, but it might show up as a negative investment on the Schwab site. And so that's why I recommend, if you're going to go in the weeds, look at your investments. I definitely recommend go to the Tamarack portal, our portal that we have, because that's actually giving you a total view of total return. And total return is the change in price, all the income, the dividends, the interest, what you've earned, and the time that you bought it. And so we can look at every single investment and know, what did you actually earn? And so I would just caution you from going to Schwab to see performance. It's probably not going to give you an accurate lens to see your portfolio through.
No, it's a good point. It's a good point. And I think it's also important. Hey, if you have any questions, we're always here, always available to connect with anyone at any time, whether it's through Zoom or in person. And as you mentioned, we're kind of going through now and doing year-end tax planning, year-end kind of financial items and RMDs, retirement contributions, state reviews, beneficiaries. So we're doing a lot of stuff like that right now that we'll be reaching out and connecting with folks. But at any time, we always say, hey, we're always available. It's just an email or phone call away. And, we could definitely help with some of those questions or concerns that may come up.
Absolutely. We definitely will be reaching out to everybody here the next couple months. But like you said, reach out if you got any questions. Eddie, I think this was good. Thanks for joining me.
It's good being back, and hopefully it's helpful to some folks. And if not, we're always, again, just feel free to reach out, ask any questions.
Sounds good. Take care.